Joining us to talk about her market outlook is Michelle Schneider. She's Managing Director at Market Gauge Group, and she joins us from Santa Fe, New Mexico. Thank you very much for joining us, Michelle. Investors watching these markets track downward again. Do you have any sense of when this volatility will calm down?
Well, I think we have to look at it a little bit differently this year than we've looked at the market in the past, and that is if we are sort of repeating history from inflationary times, which people haven't seen in 40 years, then we have to look at what the market did back then and get some clues. And of course, our rates are much, much lower than they were back then, but we did go somewhat into a trading range, albeit wide, throughout the 70s and into the early 80s. And that was really, I think, telling for where we can go now is into some sort of trading range. The question is, where's the floor? But if we're just looking at the S&P, I think 4,000, maybe if we broke that 3,800, could be the floor. And at this point right now, we're seeing that 4,500 as being great resistance. Now, it may go wider at some point, but I'm not looking for a big crash like people are looking for. I'm thinking more that we will stagnate, and which goes very much with the theme of stagflation, and here we are.
Define stagflation for us as you see it and why it's important for investors.
Because in a stagflationary environment, basically you have inflation going up, and that's exactly what we're seeing. But you see the economy literally stagnating, and that is also what we're seeing. So even though the GDP numbers came out strong for the fourth quarter, really if you look under the radar, it was showing that we're going to see slowdown into the first quarter here, and certainly we're seeing some economic stats to that. PCE supports the inflation narrative today. And then in walks the Fed, which I believe they think still inflation is going to fizzle out, but they're all ready to act more aggressively. All of that means for you is that instead of looking at all the cyclical stocks that we have enjoyed great runs with free money for the last 12 years, you now want to look more at non-cyclical type stocks, things that people need and not necessarily that they don't need and just going to buy because they feel flush with cash and optimistic.
Several companies have pointed to supply chain issues recently, more than several, many have, and they've pointed to the inflationary pressures that tend to arise from supply chain bottlenecks when the supply of certain products or inputs is constrained. Apple seems to have dealt with those supply chain issues much more ably than was expected in its results. Is there any visibility for investors at all when these supply chain issues may ease and we'll see a calming down of at least that source of inflation?
Well, it certainly will at some point ease. There's no doubt about that. But things take time, and that's really what we're looking at. The Fed is exactly what they're saying, is things will ease. But the question is when? 3 months, 6 months, 9 months? So if you are holding a portfolio of a lot of growth stocks, and you're ready to take a bit of a hit, that's one thing. But otherwise, if you can be more protective and think along with that, what did we just see? General Electric, Intel, all of them had good earnings, Microsoft. But particularly General Electric and Intel, what did they say? They have the trifecta here of labor issues, supply chain issues, and inflation plaguing them. Even Apple, with their strong earnings, having somewhat skirted, is a cyclical. So it could actually go down. So that's kind of what we're looking at right now. I do believe that the market will give a great buy opportunity. I'm just not seeing it just yet. I want to really know that there's a floor here in terms of the support levels that we're talking about.
Okay, we've got a graphic up on screen that details some of the investing ideas that you've provided us with. The first one is medical suppliers.
Yes, well, there's two unique opportunities here. And of course, everything is going to react to gravity and go down if the market collapses. But I really like this space for a couple of reasons. Number one, it's a non-cyclical, exactly what we're talking about. People do need medical care. But the other is the unique opportunity that comes out from COVID. Because during this whole COVID situation, people stopped going to the doctor for regular stuff. And people stopped getting more elective or even non-elective procedures because they weren't going to the hospitals. And this is an area that I think can really grow. Medical devices, some pharmaceuticals, that's really carefully what we're watching. A stock like Vertex, for example, is doing very, very well in this environment. And I think that's just sort of a shades of things to come.
Number two on your investing ideas is retail, with Levi's being one of the names there.
I think you want to look for, in terms of retail, obviously there is cyclical and then there's non-cyclical like consumer staples. I picked Levi because they just reported, and obviously they're going to have the same issues with inflation and supply chain and labor as everywhere else. But I do believe that a company like that is more forward-looking in terms of the fact that they are looking at sustainability. It's in their message. It's blue jeans mainly, not just totally. People wear jeans no matter what. That could be an interesting company. But again, I would just be a little bit cautious about running into anything until we see the volatility calm down.
The banks, lots of attention on big U.S. and international banks as interest rates rise.
Well, financials look like they were going to explode, particularly after earnings, but they've come off with the market. And of course, they're going to really look for rate increases. And so that's why it's a good place to look at if the Fed actually does go with what they're saying, which is raise the rates.
We just had a conversation with one of our reporters on the ever rising price of crude oil. The energy stocks have done very well in this country and south of the border where you are in the United States. You think, however, that trade is getting crowded?
It's definitely getting crowded, considering when I listen to a lot of analysts that the energy in oil is the first thing that they say. And listen, I think it could go up. Certainly oil easily can go to $100 a barrel for many different reasons, and these energy companies can go up. But at some point, if you're getting in now, you really have to understand your risk. And also, the other interesting opportunity that could come from that is if oil gets to a certain level, then alternative energy, which has been completely blown apart, could actually start doing better because people could say, oh, wow, oil's just so expensive, there's got to be another way.